updates. No teams, no sponsors, no filters. Just me, a signal from the quietest place on earth, bringing you the most important Bitcoin news before the world wakes up. With BlockSonic, you don't need to search for information. I research, I write, and I tell the story behind every headline. I do the digging. I chase the truth. All you have to do is listen. Today, our news: Bitcoin waits on CPI while leverage tells you more, is our reminder that price can pause while intention keeps moving. You and I will watch Bitcoin hover ahead of the inflation print, not because one number commands the world, but because many traders choose to wait for permission. And while spot looks calm, derivatives quietly confess the crowd's posture. Leverage cleaned up, funding positive, yet downside protection still bought at a premium. That mix tells us more than the candle. We'll also trace the hard logic of a promised daily return, ending in a 20-year sentence, because arithmetic always catches up with storytelling. Then we'll ask what it would take to unbreak the long rally, why 85,000 matters, and what we're really seeing when Bitcoin falls with stocks. Stay close. The pattern is simpler than it first appears. When Bitcoin waits on inflation, prices hold still, but intentions do not. You see calm on the surface, yet beneath it, traders reveal their private expectations through derivatives. Leverage looks cleaner. Funding has turned positive. An institutional basis is rising, even as people still pay extra to insure against near-term downside. You and we begin with a paradox. The price barely moves, yet the market is speaking loudly. Early Friday, Bitcoin rose to test $67,000 and almost immediately met resistance and pulled back. Still, relative to midnight Universal Coordinated Time, it remained about 1% higher, while Ethereum rose roughly half as much from its own level, near $1,946. You might call this a quiet session, but quiet is not empty. It is often a pause, filled with calculation. Look one layer wider, and the broad basket. The CoinDesk 20 index was little changed, up about 0.7% over the same stretch. Nothing here feels like a stampede. And that is precisely why it matters. When action slows, every remaining trade becomes more deliberate, more revealing of preference. Now we notice the conflict in time. These small gains look like a recovery from the prior day of United States trading, when the market slid back toward last week's lows. Yet Bitcoin still sat on a path toward a fourth straight week of declines, the longest such streak since mid-November. You can feel the tension. The short run offers a bounce, while the longer run still carries the weight of disappointment. And when disappointment lingers, another pattern tends to appear. Activity thins out. A slowdown in trading and a fading of volatility weigh on volumes, because fewer people are willing to pay for urgency when they do not trust their own timing. In markets, waiting is also an action, chosen because the cost of being early feels larger than the cost of being late. Here's the midstream question you should hold. What are traders waiting for, if not a new piece of shared information that can coordinate expectations? The likely focal point is the United States Consumer Price Index reading due later today. If the number arrives higher than forecast, bond yields and the dollar can rise, and that combination often tightens conditions for assets people treat as risk. If the reading comes in lower, it can suggest easier conditions ahead, the sort that invites more risk-taking. Notice what is happening. A single public statistic becomes a temporary lighthouse, not because it creates value, but because it synchronizes beliefs. Yet we should not confuse synchronization with certainty. Even if the inflation print tilts sentiment, the distance to a major price threshold remains large. To reach $85,000 would require not a mild nudge, but a meaningful shift in willingness to bid, sustained over time. Jean-David Pequignot, chief commercial officer at Deribit, framed that level as a signal that the longer-term rally is no longer broken. Whether you agree with the exact number is secondary. The logic is primary. Markets look for levels that would force a change in narrative because they would force a change in behavior. Now return with us to the derivatives market, because it is where intentions often confess themselves first. We see tentative optimism. Leverage appears cleaned up. Funding rates are positive, and institutional basis is rising. These are not poetic signs. They are the footprints of traders choosing to hold exposure rather than flee it. And still, at the same time, traders pay a premium for short-term downside protection. That is not hypocrisy. It is human action under uncertainty, the desire to participate without surrendering to ruin. So when you observe Bitcoin and Ethereum, little changed? Do not stop at the surface. The stillness is not the story. The story is that people are rearranging their risks, pricing their fears, and waiting for a shared signal to coordinate the next step. Let us pause here together. The market did not fall silent. It simply spoke in the language of restraint. And once you hear that language, you realize it was always there. If you have your own way of reading that restraint, it is worth setting it beside ours and seeing what each of us noticed first. A promised daily return, a real 20-year sentence, the logic behind a Bitcoin Ponzi. You and we both know the temptation, a simple promise of steady gain, wrapped in the language of sophisticated trading. Stay with us, and we will trace how that promise collapses the moment we ask where the returns can actually come from. You can feel the paradox at the start. If wealth can be produced on command day after day, why would anyone need your money at all? We are looking at the chief executive of Praetorian Group International, sentenced to 20 years in prison in the United States for operating a global Ponzi scheme that claimed it was investing in Bitcoin and foreign exchange trading. Now slow down and notice what matters first. A human being acts purposefully, and he must persuade other human beings to part with scarce resources. The instrument of persuasion here was not a factory, not a product, not a verifiable strategy, but a story of effortless compounding. Ramil Ventura Palafox, 61 years old, promised daily returns of up to 3%. More than 90,000 investors were drawn in, and over $62.7 million in funds were drained, according to a Thursday statement from the United States Attorney Office for the Eastern District of Virginia. Here is the midpoint hook we should not ignore. 3% per day is not merely ambitious. It is a claim about reality itself. It implies a machine that converts uncertainty into certainty and risk into routine. When you hear that, reason asks one question before all others. What market process is producing these gains? And what losses are being borne to earn them? Court records say Praetorian Group International collected more than $201 million from investors between late 2019 and 2021, including over 8,000 Bitcoin. And instead of investing the money as promised, prosecutors said Palafox used new investor funds to pay old ones while siphoning millions for himself. You see the structure now. The appearance of profit is not created by successful trade, but by redistribution disguised as return. The early participant is paid with the later participant's contribution, and the scheme survives only as long as fresh trust keeps arriving. To keep the illusion alive, Palafox built an online portal where investors could track their supposed profits. The numbers were entirely fabricated. This is not a minor detail. It is the economic heart of the fraud. When genuine enterprise earns profit, it can be tested against reality. Inventories, counterparties, audited accounts, and the stubborn discipline of prices. But when a profit is a number on a screen, the only thing being produced is belief. And belief, unlike capital, can be manufactured quickly. In reality, Prosecutors say Palafox was buying Lamborghinis, luxury homes in Las Vegas and Los Angeles, and penthouse suites at high-end hotels. They say he spent $3 million on luxury cars and another $3 million on designer clothing, watches, and jewelry. Pause with us here, because this is where many people misunderstand the lesson. The scandal is not that someone lived lavishly. The deeper contradiction is that the promised investment activity did not need to exist at all, as long as the flow of new funds could sustain the old promises and finance the private withdrawals. The case was investigated by the Federal Bureau of Investigation and the Internal Revenue Service. Victims may be eligible for restitution. The Securities and Exchange Commission is pursuing civil penalties, and Palafox remains banned from handling securities. So what do we take from this, you and we without theatrics? When a return is offered as a certainty detached from any clearly bearable risk, reason should immediately search for the hidden payer. If no productive source is visible, the only remaining source is other participants. The portal can display any number, but it cannot conjure real coordination out of fiction. Let that settle quietly. The deception was not only in the man. It was in the invitation to stop asking how value is actually created. If you have ever felt the pull of a steady daily return, tell us what question you wish you had asked first. If you believe in what we're doing and want to support BlockSonic's growth, just scan the QR code on the screen or copy the link in the description. Every contribution makes a difference and helps us keep delivering quality, independent, and up-to-date content for you. Bitcoin's long rally feels broken until it reclaims $85,000. You and I can watch the same chart and still miss the real question. When does a market stop being a rising story and become a test of conviction? We will trace why one level, $85,000, has become the line between renewed control and continued drift, and why the next supports are less about lines and more about human psychology. You see the paradox immediately. A price can hover calmly, and yet the longer arc can still be damaged. We are not dealing with a mystical object called the market. We are watching countless individuals, each acting with purpose, each choosing when to hold, when to sell, and when to wait. When those choices cluster around certain prices, the chart merely records the human pattern. A derivatives exchange executive, Jean-David Pequegnot, frames the pattern bluntly. Bitcoin's long-term rally is broken, and it will remain so until price climbs back above $85,000. Notice what this really means. It is not a prophecy. It is a claim about control. Who is setting the terms, the marginal buyer or the marginal seller? Now look at where price has been living. Over the past week, Bitcoin has settled into a band between $60,000 and $70,000. That range feels stable, but stability can be a pause, not a resolution. It also sits roughly 45% below the record high reached in October, a reminder that memory still weighs on decision-making. Here is the quiet tension. Bitcoin fell below $85,000 at the end of January, and it has been sliding toward a fourth straight weekly decline. When a market loses a level that many treated as a floor, the loss changes behavior. Some participants become defensive. Others become opportunistic. Many simply become hesitant, and hesitation itself is information. Pequegnot's deduction is technical in language but human in substance. Until the market reclaims $85,000, the longer-term chart remains broken, and the path of least resistance remains lower. In other words, absent a decisive shift, the easiest next move is not up but down, because sellers do not yet feel fully absorbed. Pause with us here, because this is the first mid-course hook. What does it mean to absorb supply? It means buyers accept the available coins at that level without flinching, again and again, until sellers stop pressing. A rally is not an emotion. It is the visible outcome of repeated successful buying under pressure. Rising above $85,000 would therefore signal that buyers have re-established control, having taken in the supply that previously overwhelmed the market and cracked the longer-term story. Without that reclaim, price may bounce, but it does not yet persuade. At around $66,600 recently, Bitcoin remains well below that make-or-break threshold, leaving room for further discomfort if sellers continue to find willing exits. And now we meet the next question you should be asking. If the reclaim fails, where does the next confrontation occur? Bitcoin points to $60,000 as the next major support. This is not because 60,000 is sacred, but because round numbers become psychological meeting points. Large buy walls have historically formed there, meaning many purchase orders cluster at that level, waiting to catch a fall. You can think of it as a crowd gathering at a familiar intersection, not because the intersection is magical, but because everyone expects everyone else to be there. Notice the second paradox? A support level is strongest precisely because it is widely seen, yet it can fail precisely because it is widely relied upon. If too many people place their hope in one line, a break can trigger a synchronized retreat. Bitcoin adds a condition that matters. If $60,000 fails to hold on a closing basis, the next logical stop is the 200-week moving average, possibly the final stop for this correction. Close matters because it reflects where people are willing to remain committed after the day's uncertainty has passed. The 200-week simple moving average is treated by many traders as the place where bargain hunters appear at bear market lows. Since 2015, multiple Bitcoin bear markets have found lows near this average, which is why attention gathers around it, not because the average forces action, but because shared attention changes action. At present, that moving average sits around $58,000. So the practical zone becomes clear. The band from $58,000 to $60,000 is framed as the ultimate support, the place where the next wave of buyers might decide whether this decline is merely a correction or something more enduring. Let us end with the calm implication. These levels are not commands issued by a chart. They are summaries of human choice under uncertainty. If Bitcoin reclaims $85,000, you are watching buyers demonstrate dominance by taking supply without hesitation. If it sinks towards $60,000, you are watching belief meet fear at a number everyone can say out loud. And if it reaches the 200-week average near $58,000, you are watching a long memory test whether value is still felt strongly enough to invite new commitment. If you have ever noticed how a single number can change your mood, you already understand more of this than you think. If a particular level feels decisive to you, we can sit with why that is, and what it reveals about how you interpret risk and opportunity. Bitcoin slides back toward last week's lows as artificial intelligence doubts unsettled software, and even needles fall quiet. The same thread of expectation runs through software, crypto, and even the old refuges of gold and silver, and when that thread tightens, prices move together again. You might think Bitcoin lives in its own world, but watch what happens when fear changes its address. The fall appears first in software screens, then in crypto charts, and then unexpectedly in the metals that people call safety. Bitcoin drifted back toward last week's lows, surrendering almost all of its recent climb above $70,000 and returning to the mid-$60,000 range as weakness spread across the broader technology complex. Over the past 24 hours, Bitcoin was lower by about 2%, and you could see the same rhythm in Ethereum and Solana, each declining in a way that suggested not separate stories, but one shared mood. Now, let us ask a simple question together. What links these assets if not physical similarity? Not substance, but expectation. The same buyers who bid up software on visions of future profit often bid up crypto on visions of future adoption. And when their confidence tightens, they sell what they once grouped together in their own minds. That is why the decline mirrored the larger move in the Nasdaq, which fell about 2% on Wednesday, and even more clearly in software itself, where a technology software sector fund dropped about 3%. Here the contradiction becomes sharper, and you can feel it. Software is valued for what it can do, yet the market is now asking whether artificial intelligence agents will compress the value of today's coding labor. When the anticipated scarcity of skill looks less scarce, the price people are willing to pay for the firms built on that skill begins to soften. This is why that software fund is now down about 21% year to date. The multiple was never a fact of nature. It was a collective judgment about the future, and collective judgments change when new capabilities arrive and old certainties lose their grip. A strategist observed that software stocks were struggling again, and that the sector was essentially back to last week's panic lows. We do not need the drama of the phrase to see the logic. When a crowd revises its forecast, yesterday's fair price becomes today's error to be corrected. Then comes the more provocative line, and it is worth holding in your mind. Crypto is another kind of software, programmable money, and the market can treat them as the same thing. Not because they are identical in function, but because the same holders often file them under the same mental category. Long duration, expectation heavy, future-weighted assets. Pause here with us for a moment. If people are selling software because the future feels less legible, why would they not also reduce exposure to a monetary technology whose value also depends on a future they must imagine rather than touch? And yet the day offered another surprise. Gold and silver, which many consider the opposite of speculative technology, suffered their own sharp drop in the afternoon, fast enough to remind you that safe does not mean immune. Late in the session, silver was lower by about 10–30% to about $75 per ounce, and gold was down about 3.1% to about $4,938. What do we learn when even metals fall alongside software and crypto? We learn that liquidation is a human action before it is a theory. When people seek cash, reduce leverage, or simply retreat from uncertainty, they sell what they can sell, not only what they wish they did not own. Though the deeper pattern is not that Bitcoin imitates technology by accident. It is that portfolios are made by minds, and minds group assets by stories, time horizons, and shared holders. When the story shifts, correlation reappears as if it had been waiting patiently all along. If you have ever wondered why markets sometimes move as one organism, hold this day as a quiet example and tell us, in your own words, which story you think investors are rewriting right now. And don't forget to subscribe to the channel, share with your friends, and participate in the chat. These simple actions really help the project grow and keep BlockSonic running at full speed every day. When innovation pushes prices down, why Bitcoin still finds its place. We need to look at a strange fear forming in the modern mind. Not the fear of prices rising, but the fear of prices falling too fast to be understood. You are about to see why one investor claims Bitcoin survives not only inflation, but a coming deflation born from accelerating tools, and why that deflation could expose fragile arrangements that once seemed permanent. You and we both know the usual story. Money loses purchasing power, so people seek shelter. But let us begin with the paradox that unsettles the comfortable thinker. What if the storm ahead is not higher prices, but lower prices arriving with such speed that yesterday's plans cannot adapt? In New York, during a conversation at Bitcoin Investor Week, Cathie Wood of ARK Invest spoke as if she were watching a productivity wave build beneath the surface. She suggested that artificial intelligence, robotics, and other exponential technologies are not merely improving life at the margin. They are compressing costs so quickly that the price system itself will be forced to speak in a new tone. Now pause with us, because this is where many minds stumble. You have been trained to associate deflation with collapse and despair. Wood is pointing to a different source. Not a shrinking world, but a world where output rises while the required inputs fall. In plain terms, the baker learns to bake more bread with less flour, less labor, and less wasted time, and the consequence is not ruin, but cheaper bread. Yet, even beneficial deflation creates conflict, because human plans are made in time. If lenders, borrowers, and institutions have organized themselves around the expectation of steady price increases, then rapid price declines do not feel like a gift. They feel like an assault on every contract written under yesterday's assumptions. Wood's claim is that many established financial arrangements are accustomed to a narrow band of inflation, and will struggle when that band breaks. Here is the midpoint hook we should not ignore. The more productive the world becomes, the more it punishes those who rely on slow adjustment. If a system needs stable margins to service old debts, what happens when innovation compresses margins everywhere at once? You can already sense the tension between technological abundance and debt-based expectations. Wood offered specific signs of acceleration. She pointed to artificial intelligence training costs falling by roughly 75% per year, and inference costs dropping by as much as 98% annually. Whether the exact figures hold is less important than the direction they describe. Capabilities rising while costs fall, year after year, as entrepreneurs discover better methods. And now we arrive at her warning about interpretation. She argued that the Federal Reserve, relying on backward-looking data, may fail to recognize innovation-led deflation until the adjustment becomes disorderly. Notice the logic. If your measurements look into the rear-view mirror, you will respond late. And late responses tend to be larger, rougher, and more disruptive than timely ones. So where does Bitcoin enter this chain of reasoning? Wood's answer is simple in form, though not simple in implication. She calls Bitcoin a hedge against both inflation and deflation, because its appeal is not only about purchasing power. It is also about counterparty risk, about the fragility of layered promises when the environment changes faster than the promise makers can adapt. When deflation compresses profits, it does not merely lower prices. It tests business models. It pressures intermediaries. It reveals which balance sheets were built on sturdy savings and which were built on assumptions that required perpetual expansion. Wood pointed to underperformance in software as a service stocks and to emerging risks in private equity and private credit, not as isolated events, but as early tremors of a broader repricing. Here, the contrast she draws becomes clearer for you. Bitcoin, in her view, does not depend on the solvency of a central counterparty. It does not ask you to trust a chain of institutions whose internal exposures you cannot fully see. It asks you only to understand its rules and to accept that its supply is fixed by design rather than adjusted by discretion. We should be honest about the deeper human action underneath this. When uncertainty rises, you do not merely seek returns. You seek reliability. You seek a framework where the rules are legible, where calculation is possible, where you can act without needing permission from opaque layers of authority. That is the psychological and economic niche Wood believes Bitcoin can fill during rapid technological disruption. She also framed the moment as the reverse of the technology and telecommunications bubble. Back then, she argued, capital flooded into tools that were not ready to deliver what the stories promised. Now, she claims, the tools are real, and the world is only beginning to reorganize around them. The bubble, in this telling, was not the technology itself, but the timing of belief versus capability. Wood then grounded her firm's posture in continuity. ARK Invest, she said, has built portfolios around the convergence of disruptive technologies for years, including blockchain. She noted that the firm is among the larger holders of Coinbase and Robinhood, alongside other allocations tied to the digital asset ecosystem. The point is not the ticker. The point is that she sees coordination shifting toward new rails, and she has positioned accordingly. Let us add the final hook quietly, because it is the one that matters. If the narrative shifts from inflation to productivity-driven deflation, then the old habit of interpreting every macro change through the lens of rising prices becomes a kind of blindness. And blindness in markets is not punished by argument. It is punished by consequence. Wood ended with a confidence that truth will win out, and we can translate that into a calmer proposition. Reality asserts itself through profit and loss, through adaptation and failure, through the relentless test of whether plans align with the world as it is becoming. Zoe, we pause here together. You can feel the shape of the deduction now. Accelerating innovation can lower prices. Lower prices can strain debt-structured expectations. And strained expectations reveal where trust was assumed rather than earned. If you have seen that chain clearly, you will start noticing it everywhere, long before anyone declares it official. If this line of reasoning resonates with what you have been sensing but not yet naming, leave your own observation of where you think the next stress point will appear, and we will examine the logic together. When Bitcoin falls with stocks, what are we really watching? You are not watching a number drift on a screen. You are watching countless minds revise their plans at once, and the price merely confesses what those plans have become. Here is the paradox we begin with, and you have likely felt it before. When stock prices rise, Bitcoin often acts as if it lives in its own world. Yet when stock prices fall, Bitcoin suddenly remembers the same gravity. As late morning trading unfolds in the United States on Thursday, you see Bitcoin slide back toward the lower edge of its recent range, arriving below $66,000 as the Nasdaq declines by roughly 1.6%. We do not need mysticism to explain this. When uncertainty rises, people reach for liquidity, for safety, for the familiar exits. Prices move first, and explanations run after them. Look closer and you notice the quiet arithmetic of repricing. Bitcoin trades near $65,700, down about 1.5% over the past 24 hours. Ether hovers just above $1,900, down more than 2%. These are not merely crypto prices. They are the market's current verdict on how urgently people wish to hold these assets versus how urgently they wish to hold something else. Now we arrive at a pattern that keeps repeating, and it is worth your attention. The crypto sector appears uncorrelated when the Nasdaq climbs, yet becomes tightly correlated when the Nasdaq sinks. That is not a technical riddle. It is human action under stress. In calm moments, people indulge differentiation and narrative. In fearful moments, they simplify. They sell what feels optional, and they protect what feels necessary. And notice what happens when a plunge fails to produce a sustained bounce. The hopeful buyer, the one who wanted a clean reversal, begins to doubt. The leveraged trader is forced to reduce exposure. The long-term holder watches the crowd and wonders if the crowd knows something he does not. This is how capitulation is born. Not as a slogan, but as the cumulative surrender of plans that no longer feel viable. Midway through this, you are shown a thermometer of sentiment. The crypto fear and greed index falls to 5, a reading labeled extreme fear. Even lower than levels seen during the collapses of the crypto winter of 2022 and the COVID crash of 2020. We should treat such indices carefully, but we should not ignore what they represent. They are a proxy for time preference under pressure, for how quickly people want relief and how little patience they believe they can afford. Then another signal arrives, and you can feel why it catches attention. Jeff Kendrick of Standard Chartered, long known as a bull, cuts price targets for Bitcoin, Ether, Solana, BNB, and AVAX, while warning Bitcoin could dip as low as $50,000. When a committed optimist revises downward, the market hears not just a new number, but a shift in perceived probabilities. The point is not whether his target is correct. The point is that expectations themselves are tradable. And when they change, portfolios change. Now, let us ground this in the businesses that live on trading activity. Coinbase and Robinhood fall sharply, each down more than 8%. You can deduce the logic without any special access. When prices fall and confidence thins, trading volumes often shrink, spreads change, and the easy revenue fades. Coinbase is set to report fourth quarter results after the bell. And Robinhood's recent fourth quarter report already showed that the bear market had bitten into crypto trading revenue in the final 3 months of 2025, before the early 2026 turbulence intensified. Here is another small hook to keep in your mind. The market is not punishing these firms for what they are, but for what their customers are likely to do next. A business built on transaction flow is, in a sense, a mirror held up to collective willingness to act. The decline spread outward. Strategy falls around 4.2%. Circle Financial falls around 4.3%. Hut 8 falls around 6.6%. Each ticker is different, yet the coordination is the same. When the marginal buyer becomes cautious, the entire complex reprices around that caution. So what are we really watching when Bitcoin sinks below $66,000 alongside falling stocks? We are watching preference rankings reshuffle in real time. We are watching uncertainty compress narratives into one urgent question. What must I hold, and what can I let go? If you sit with that for a moment, you may notice the quiet clarity behind the noise. Prices do not create fear or confidence. They reveal where fear and confidence have already moved. And if you have seen that once, you will start seeing it everywhere. If this way of looking at markets changes what you notice in the next downturn, leave your own observation of that moment for us to consider together. And don't forget to subscribe to the channel, like, share with your friends, and participate in the chat. These simple actions really help the project grow and keep BlockSonic running at full speed every day. Crypto for Advisors. How exchange-traded wrappers pull digital assets into portfolios. You and we are watching a simple pattern repeat itself. Once a new asset gains a familiar wrapper, it stops being strange and starts being allocatable. Digital asset exchange-traded products now hold $184 billion, not because beliefs changed overnight, but because distribution channels finally learned how to carry the thing. You might think adoption begins with conviction, but in markets it often begins with convenience, and that is the paradox worth holding at the start. In this note, we walk with you through a recent research summary from Joshua DeVos, head of research at CoinDesk, because it captures the mechanism clearly. Not, crypto is popular, but crypto has found the infrastructure that traditional portfolios already know how to use. When access is fragmented, each buyer must build their own bridge, and bridges are costly. When access is standardized, the bridge becomes a product, and suddenly the marginal decision changes. You no longer ask, how do I hold this? You ask, how much do I allocate? The wrapper turns a technical problem into a portfolio question. That is why digital asset exchange-traded products have become such a clean signal. They reveal integration not through slogans, but through the quiet arithmetic of custody, compliance, distribution, and rebalancing. The market moved from improvised pathways to regulated containers, and capital tends to flow where its own constraints feel respected. Now, look at the present state of adoption. By the end of 2025, assets under management in crypto exchange-traded products reached $184 billion. The center of gravity sits in the United States, with roughly $145 billion, close to 4/5 of global assets. This is not mysticism. It is simply where the largest distribution networks and the most established exchange-traded fund habits already live. Pause with us here, because a second pattern appears. These products are not exotic. They are mostly plain exposure. Exchange-traded funds dominate the landscape, representing 84.6% of structured product assets. Around 94.1% use a Delta One strategy, and 96.1% are passively managed. In other words, most participants are not seeking cleverness. They are seeking a clean, legible claim. So what lit the fuse? The launch of United States spot Bitcoin exchange-traded funds in January of 2024. You can call it a step change, but the logic is simpler. Once the familiar wrapper existed, the asset could enter the same allocation frameworks used for equities, fixed income, and commodities. The channel did not merely transmit demand, it organized it. And the speed matters, not as a contest of prestige, but as evidence of distribution at work. United States Bitcoin exchange-traded funds reached $100 billion in assets in just 11 months. United States gold exchange-traded funds took nearly 16 years to surpass the same milestone. This does not prove one asset is superior. It proves that once the rails are built, flows can accelerate with startling calm. Here is a mid-course question we should ask you directly. What looks like a sudden change in belief is often just a delayed release of already existing preferences, waiting for a usable form. Now we turn to scale and concentration, because every growing category reveals its structure through what it excludes. Bitcoin-based products account for about $144 billion, roughly 78.2% of total assets under management. Ether-based products have reached $26.5 billion, suggesting demand is broadening, but only gradually. Outside those two, the numbers thin quickly. Solana-linked products manage about $3.8 billion. XRP-linked products manage about $3.0 billion. Multi-cryptocurrency exchange-traded products represent 0.62% of total assets, about $2.16 billion. This is what early institutional integration usually looks like. First liquidity, then familiarity, then breadth. If you feel a tension here, it is real. People speak of diversification, yet they begin with concentration. The reason is not hypocrisy. It is calculation under uncertainty. Institutions start where price discovery is deepest, where trading is thickest, and where the cost of being wrong is easiest to measure and unwind. From that foundation, the pipeline begins to broaden. By the end of 2025, more than 125 digital asset exchange-traded product filings were pending. Bitcoin still leads, but XRP and Solana follow as the most active single asset categories. This is the market testing what else can bear the weight of a standardized wrapper. Another development is quieter but more revealing. The growing momentum behind basket products. Multi-cryptocurrency products are still small by assets, yet they are the second most active category by number of pending filings. That should make you curious, because baskets become attractive when markets mature, correlations shift, and concentration risk becomes harder to ignore. Indices such as the CoinDesk 5 and CoinDesk 20 are increasingly used as reference points for exchange-traded products, structured notes, and derivatives. When benchmarks emerge, they do not merely describe the market. They shape what can be packaged, compared, and owned. Standardization is not a footnote. It is a force. Yet we should not mistake current assets under management for full participation. Much of this expansion happened before broad adoption across major advice forms. Many large advisors remain in evaluation or early allocation phases, which suggests today's totals reflect initial positioning rather than a fully settled place in portfolios. Even so, The direction is visible. Some firms have only recently expanded client access to crypto exchange-traded funds, and that timing matters. Adoption often arrives not as a wave, but as a sequence of gates opening one after another, each gate converting the unusual into the permissible. Looking ahead, context steadies the mind. Global exchange-traded fund and exchange-traded product assets are projected to grow to roughly $30 trillion by the year 2030. If that world is even approximately true, then even modest allocation decisions could translate into a materially larger digital asset exchange, traded product market over time. The point is not prediction. The point is proportion. Small percentages applied to vast pools become large realities. This entire picture was drawn from CoinDesk research report on the digital assets, exchange-traded product landscape, past, present, and future. But the deeper lesson is general. Capital does not only chase returns. It also seeks forms that fit its own constraints. So we end in a quieter place. What you have seen is not a story about hype. It is a story about wrappers, rails, and the way familiar structures invite new choices without needing new personalities. If you have noticed this pattern elsewhere, in other assets or other moments of financial history, hold that thought and bring it with you, because it tends to reappear in places we overlook. Standard Chartered deduces a Bitcoin fall toward $50,000 and Ether toward $1,400 before the market finds its feet. You and I are watching a familiar human pattern. When uncertainty rises, people sell not because they have new knowledge, but because they want relief. Standard Chartered has lowered its near-term and full-year expectations for the major digital assets, reasoning that outflows from exchange-traded funds and a harsher macro backdrop can still force a final wave of capitulation. Yet in the same breath, it holds to a recovery path once a bottom is discovered and accepted. If you want a paradox to begin with, here it is. The more institutional an asset becomes, the more it can behave like a crowd in a narrow doorway when fear arrives. We start with the bank's deduction. When exchange-traded fund holders pull money out, they create mechanical selling pressure that does not wait for a philosopher's debate about long-run value. Standard Chartered reads those outflows as a near-term weight on price, and it lowers its forecasts accordingly. From that premise, it draws two concrete expectations. It sees Bitcoin sliding toward $50,000 in the coming months, and it sees Ether potentially finding a low near $1,400. Notice what is really being said, not that the assets have lost all purpose, but that the next marginal seller may be more urgent than the next marginal buyer. Now look at the present moment described in the piece. Bitcoin was trading around $67,900 at the time of publication, while Ether was trading around $1,980. The market is not yet at the levels the bank sketches, which is precisely why the warning matters to those who still believe current price is the same thing as stable price. Here we meet the human actor inside the chart. Jeff Kendrick, who leads the bank's digital assets research, argues that the recent sell-off could extend because many exchange-traded fund investors are sitting on losses. And when a person is holding a losing position, the desire to stop the pain often outweighs the desire to be proven right later. In such moments, buy the dip is not a strategy. It is a temperament, and temperaments are scarce. But Kendrick does not stop at the downward motion. He adds the conditional that changes everything. Once prices establish a bottom, he expects a recovery through the rest of 2026. This is not prophecy. It is a statement about how markets grope toward a clearing price when panic exhausts itself, and the most impatient sellers have already acted. Here is a midstream question you should hold in your mind. If everyone is waiting for clarity, who exactly is left to create it except the entrepreneur willing to buy when clarity is absent? The bank's revised year-end targets show the same logic in a broader frame. It reduces its Bitcoin year-end target to $100,000 from $150,000. It lowers Ether to $4,000 from $7,500. It also cuts Solana to $135 from $250, BNB Chain to $50 from $1,755, and AVAX to $18 from $100. These are not merely numbers. They are a map of reduced confidence about near-term coordination between buyers and sellers. The article then widens the lens to the cycle itself. Early 2026 has been weak, with major assets falling from late 2025 highs and total market capitalization declining sharply over recent weeks. Bitcoin is described as down almost 23% since the start of the year. In plain terms, many plans made under yesterday's optimism are being liquidated under today's doubt, and doubt expresses itself through volatility. The downturn has included large liquidations of leveraged positions and a broad risk-off mood, with crypto moving more closely alongside weakening equity markets. When leverage is present, small price moves become forced decisions, and forced decisions look like market sentiment even when they are simply margin mechanics. Now we come to the macro pressures named in the piece. Concerns about global growth and the outlook for interest rates have pushed investors toward traditional havens like gold. Add to this stalled regulatory clarity in the United States and liquidity strains at some institutions, and you get a general reduction in confidence. The consequence is predictable. Less trading, lower revenues for crypto-exposed firms, and bearish talk spreading across many tokens. But the most revealing detail is not the mood. It is the positioning. Kendrick notes that holdings of Bitcoin exchange-traded funds have declined by nearly 100,000 Bitcoin from their October 2025 peak. He adds that the average purchase price is around $90,000, leaving many investors with unrealized losses of roughly 25%. When the average holder is underwater, the market is not just pricing an asset. It is pricing human patience. Another hook to keep you awake. Losses do not merely reduce wealth. They change time preference. They make the future feel expensive. Kendrick also points to macro conditions limiting near-term relief. United States economic data show signs of softening, yet markets expect no interest rate cuts before Kevin Warsh's first Federal Open Market Committee meeting as central bank chair in mid-June. Whether you agree with these expectations is secondary. What matters is that traders act on the belief that cheap liquidity will not arrive soon, and so they reduce exposure now. Even so, the bank argues this drawdown is less severe than earlier cycles. At the worst point in early February, Bitcoin was down about 50% from its October 2025 all-time high, and roughly half of supply remained in profit. Sharp, yes, but not the total devastation seen in other downturns. In other words, the selling is intense, but it is not yet the kind that comes from universal insolvency. Then comes the crucial contrast. This cycle has not seen the collapse of major crypto platforms, unlike the failures associated with Terra and Luna and FTX in 2022. Kendrick reads this as a sign of maturation and resilience. And you can see the deeper implication. When fewer core institutions fail, the market's learning is less about ruins and more about repricing. Finally, the bank's longer-term projections remain unchanged. It maintains end of 2030 targets of $500,000 for Bitcoin and $40,000 for Ether, arguing that usage trends and structural drivers remain intact. The same institution that warns of capitulation also holds a distant horizon of adoption. That is not contradiction. It is simply the recognition that short-run prices are often set by flows and fear, while long-run prices are shaped by whether an asset continues to solve real coordination problems for real people. We end where we began, quietly. You and I are watching purposeful actors under scarcity, choosing between regret now and uncertainty later. The chart is only the shadow of that choice. If you have seen yourself in any of these incentives, you may want to leave your own reading of where the bottom truly comes from numbers or from exhausted human urgency. And don't forget to subscribe to the channel, share with your friends, and participate in the chat. These simple actions really help the project grow and keep BlockSonic running at full speed every day. Banks did not defeat stablecoins. They misread the battlefield, Lin Han says. You and I are watching a quiet inversion. The old guardians of money still speak as if they can prohibit a tool, while the market treats that tool as a more efficient way to coordinate trust. And in the same breath, Lin Han suggests another sacred rhythm is fading too. The 4-year Bitcoin cycle that once felt inevitable. If a cycle was once anchored to scarcity, why does it weaken when the world starts paying attention? You can feel the paradox already. The more a market matures, the less it obeys its own internal rituals. For years, you were taught to expect a 4-year pulse in digital assets, timed to Bitcoin's having events, as if supply alone could dictate the story. But we should begin where all analysis begins, with human action. People do not buy, sell, save, or speculate because a calendar tells them to. They act because they anticipate a future, fear a loss, or seek a gain, under conditions of scarcity and uncertainty. Lin Han, founder and chief executive officer of Gate, looks at this and says the old cycle is losing its power. Not because scarcity vanished, but because the market center of gravity moved. When a small domain grows into a global arena, its price no longer responds mainly to internal mechanics. It responds to the wider web of valuations, especially the valuations expressed in large equity markets and in major technological shifts, including artificial intelligence. Here's the first hinge of the argument. The larger the market becomes, the more it must coordinate with the wider economy's expectations. A local rhythm gets absorbed into a global tempo. Lin describes digital assets as having matured into something closer to a macroeconomic pillar, moving in step with United States equities and technology narratives, rather than reacting primarily to supply shocks. We can translate that into simple logic you can test in your own life. When more participants enter, the price becomes a meeting place for more knowledge, more fears, more opportunities, more constraints. The halving remains real, but its relative informational weight declines. Lin leads what he describes as the world's 4th largest exchange by daily trading volume, with daily volume exceeding $2 billion. That scale matters, not as a trophy, but as a clue. Volume is the footprint of coordination. It tells you how many plans are being revised, how many errors are being corrected, how many entrepreneurs are attempting discovery in real time. Now, notice the conflict emerging outside the trading screens? An association representing banks urged lawmakers to ban yield-on-payment stablecoins and to revise open banking rules, presenting these changes as consumer protection and competitive balance. But you and I should ask a more precise question. What is being protected, the consumer, or an existing structure of intermediation? When an administrative rule restricts how wallets, stablecoin issuers, and applications can access users and their financial data, it does not erase demand. It redirects demand into fewer channels, usually the channels already favored by the rule. That is the pattern of external imposition. It rarely eliminates an activity. It changes who may perform it, and at what cost. Lin's own phrasing is blunt. He says he no longer believes in the 4-year cycle, and he frames the market as bigger now, more connected to the global economy and the United States stock market, and no longer something you can treat as isolated. Pause with that word. Isolated. Markets are never isolated.